Let's start out with that older D's retail sales. We're expecting up 1/10. We're disappointed. Down 1.2. If we look at X autos, it was down 1.8. X autos and gas down 1.4. The number that gets plugged into higher numbers, the control number, down 1.7. Very weak. Now let's look at initial claims, shall we? From 235 to 239,000, it pops 4,000. Continuing claims move up slightly from 1.736 to slightly over 1.77 million. For our January read on Producer Price Index, expecting up 1/10, down 1/10. If we look at X Food and Energy, it is up 3/10. Somewhat similar to yesterday on the CPI. So we see the core up a bit. And if we look at X Food and Energy on a trade number, that's up 0.2. Final demand year over year up 2%. That's down 0.5% more than our last look in in December. This is January. And year over year trade 2.5, 0.3 lighter than December. So the January data on PPI is cool on the headline, about as expected. When you get to the X Food and Energy numbers in year over year light, retail sales light. So it's going to be very fascinating at the end of the month, of course, when we get our look at fourth quarter final GDP as we are halfway through February. Andrew, back to you.
Okay, thank you, Rick. Iurio is Managing Director at JM Institutional Services, also CNBC contributor, joins us with more on the numbers and your take on how the market's going to react to it this morning.
Well, I don't think they're going to love it. What we really want is we want low PPI numbers. We kind of got them there right in the head, but we want the other numbers to be pretty good. So the market wants to convince ourselves that there's reason that's the Fed are on hold that are exogenous, things like China. But the real data's coming in good. And we've seen, over the last couple of weeks, we've seen a JOLTS number at all-time high. We've seen a relatively blockbuster non-farm. So we like to believe that those things are going very well, but that there's not going to be any inflation to pressure the Fed into moving, because we're perfectly comfortable with the Fed being on the sidelines. As a matter of fact, I think that's the single biggest reason why we've had this meteoric 18% rise since December 24th. So we didn't really get anything to counter that, but it could have been a little better. So that's why I wasn't surprised that the S&P's lost a couple ticks seeing that because of the weak retail sales.